another episode of the Pathfinder Report. I'm your host today, Elissa Cruz. I'm the Director of Operations for Project Pathfinder. With me here today is our President, Joel Garui, and a very special guest, Parker Sorenson. Parker is a dear friend. I've known Parker since he was tiny. You were involved in Generation Joshua for a while, and then you came to grow up a bit. In fact, I remember at Gen J Camp, for those of you who don't know, at Gen J Camp we have the students do their taxes. And when Parker was a student, he figured out that other students didn't like doing their taxes, so he created basically a service that kids could pay him to help them do his taxes, and this was incredibly popular.
It was.
I never had to worry about paying for meals. I was proto H&R Block.
Yeah, basically.
It's great.
It was so entertaining to see. And when Parker grew up, what did Parker decide to do? Parker became an accountant. And he is also the treasurer for the Pathfinder Board. And we're really excited to have you here today, Parker, because our topic for today is taxes.
Wait, hold on. Don't run away. I promise it will be interesting.
And considering it is the 15th of April, tax day, when this airs, it's worth you giving a little bit of time to understand it. I know it sounds like we're really going to nerd out, and we are, but in a way that we think is going to be really interesting for you. That's it. Thank you.
Yeah, so let's jump into the topic. So first off, do we want to give basically some definitions of what are we talking about here?
We probably should, because frankly, when you get to taxes, you rapidly run into basically a foreign language, where there's a lot of people that throw around a lot of phrases. I've been working on a couple tax issues at the federal level now for the last 4 or 5 years, and it's amazing how often we're fighting over a thing that is literally people using the same words in different ways. So let's walk through some basic definitions for those of you that are involved in debate or some of that. You kind of understand what we're doing, which is setting the rules of the road of what means what. But okay, Parker, let me run a couple things at you really quick, and if you can give me some working definitions. First of all, what's a tax?
Well, I would say a tax is some sort of mandatory collection imposed by the government.
Fair enough.
So it's a requirement for living in a civilized society with a functioning, not dirt poor government.
Fair.
It is a collection, so it's going to be monetary or something very close to that, and it's imposed by the government versus by another organization, an NGO, an individual. It is going directly into some sort of governmental coffer that you cannot escape.
Yes, that mandatory part of it we are unfortunately mostly well familiar with. And it comes in different forms, right? We have different types of taxes. Right. There's there's property taxes, and that's if you own property, right? There's sales taxes if you're buying something. There's income taxes if you're making money. So not that everybody, because you exist, are necessarily taxed, but a lot of the different things we do to move through society have different taxes applied, and some of them are by your county or your local level government, your town, your city. Some of them are by your state. Some of them are federal, and sometimes it's all three. and yeah, so, fair enough. All right, so that's what taxes are. We also, since it's tax day, we should probably talk about tax refunds and tax credits. What are those?
So let's actually back up and take even a more holistic view. I would say 2 distinctions I want to make. First one is a tax return versus a tax refund. A lot of people use these interchangeably to mean the same thing, and they are not.
They are not.
A tax return, typically speaking, when we're talking about this as people, as individuals, by the time you are watching this video, or listening to this podcast, have filed my Form 1040 with the IRS. Mm-hmm. That is my individual income tax return for the year. That's when I go to the government and I tell them how much money I made, and I tell them what my deductions are, and how much I think I owe in tax, and I pay my tax, and they look at this and decide yay or nay, whether that is approved. Okay, a tax refund is when you have had taxes withheld or taken out of your paycheck, typically, through the year.
Most people do.
Which most people do. Right. I'm self-employed, but if you're not self-employed and you work for someone else, you almost certainly have taxes coming out of every paycheck against your tax liability for the year. So on your tax return, this piece of paper you're filing with the government, you look at the total amount of tax you owe for the year and the amount of tax you withheld, and then you true it up. And if you pay too much, congratulations, you get a tax refund after filing your tax return.
And so that's the government giving money back to you that they have that was more than you should have paid.
That is correct.
That's fair enough. All right. Now, before we get into the rest of those definitions, we probably need to have a couple common definitional discussions here, because most people, if you say the word taxes, if they don't audibly groan, they mentally groan, okay? And to be fair, I do too. I understand that. Taxes are not fun. It's like, you go to get your bill for whatever it is you're buying, whatever, and there's the cost of the item, and then you see this thing added on top, and it's an extra 5, 6, 8, 10, 15, depending where you are, percent that's something on top of it, and that doesn't go to the person where you bought the item from. It obviously isn't yours. That goes off to the government. That tax, it makes everything more expensive, right? It does, but there's a purpose for it. But I guess we have to kind of start, since we're recognizing that, at least for a decent number of audience, they are kind of coming of age where this is a thing that's going to be an aspect of their life. Like, it was one of my son growing up. He's my oldest one. He's like, Dad, before I graduate, I need to make sure I understand how to do taxes. Like, that was a serious concern for him, which is a little bit of an oddity, but in my family, that's not that weird. But that being said, it would be very good to not get that wrong, right? And there's plenty of an industry that helps with that. But taxes aren't purely just an economic action or just a lawful action. There's a moral component to taxes. Taxes have existed a lot longer than the United States of America. In fact, they are downright biblical. They exist in Scripture as a concept for good or for ill. So maybe the first question I should say is, the Bible talks about taxes a little bit. Mm-hmm. Can you tell me at least a couple of high points where it actually brings those up, or some of the stuff it says about them? Because we kind of have to start there if we're going to approach them and say, well, what does Scripture say about it first? And then go from there.
Absolutely. And I think the main example that we can think of biblically is the temple tax.
Sure.
Jesus paid it. Mm-hmm. Peter paid it. Both of them came into the temple. They paid this tax. They did not resist the fact that a tax was imposed, but complied with the government at the time to do so. And when pressed on this, Jesus made the often quoted line, render unto Caesar what is Caesar's, render unto God what is God's. Yep. And I think one of the important distinctions to make with this is that this was a tax being rendered to the Roman government at the height of its power. And even though this was a tax being paid to the Roman government, which was not a particularly just government, not a Christian government, not so much in line with moral principles, we are still obligated, for those of us who are Christians, to pay these taxes. We are still morally obligated to do so as believers.
Now, when you say that, there's plenty of people I know, plenty of friends I've worked with. We've been in politics a long time. One of the kind of the battle cries of some of the more maybe called the libertarian movement is that taxation is theft. And there's a certain element of that feels emotionally very true, because it's something I don't control, reaching into my checking account and taking money out every time I do something, either when money's going in off my income or when money's going out and I'm buying something and they're taking it. It feels like they're stealing. Are taxes actually evil?
No. And both of these are...
I know that's not going to be popular. I get
right. No, look, it's death and taxes. We don't particularly like either of them.
No,
they're both inevitable, right? And both taxes and theft are mandatory collections from you in a way. The government taxing my purchase of a cheeseburger, and some guy breaking into my house in a ski mask to steal my TV and sell it on Craigslist. Anyway.
The idea still. Right. Both those, each of those are force, in a sense. Mm-hmm. The government will escalate its response if you are avoiding taxes. Obviously, then at a certain point, force is involved because law enforcement is involved. The robber component is more like threat of harm. But there's an element of definitely force involved there. But they're not the same.
No. One of these is actually put forth in the scriptures, and in the Bible you see systems of taxation. You see that to support the Israelite government. You see that to support the temple. You see Romans 13 and talking about just use of government. And so all of these together, there's nowhere an implication that taxes in and of themselves are unjust. Now, you can have plenty of unjust taxes that are disproportionate or unfair or punitive, or you have bribery with this. I mean, there are plenty of corrupt countries.
You can do taxing wrong.
Yes.
Absolutely. But that doesn't mean that taxes as a concept are wrong. And I think sometimes we say that because something is being done badly, that the thing is bad as a concept. And that's where we're kind of splitting hairs here and going, no, the thing can be okay even if its implementation is poor. And I think most people would generally say that taxes are implemented poorly because they're taxes by nature. But that being said, those are in fact different things.
And I would push back on this concept you may hear that the purpose of a system is what it does. Right. That no, there is a just purpose for taxes, even if plenty of people, myself included, doing this professionally, have plenty of gripes with the current U.S. tax ecosystem in all of its many tendril forms.
And we're going to talk about that. That's actually one of the main points we want to talk about today, but we got to kind of set the basics for that. So
that's right.
Let's start with kind of like an understanding. We're dealing with people that are working with people that are new to this in a sense. How do taxes shape society? How do they affect our families? How do they affect how we live? Like how does it go from they take money off my debit card or credit card or whatever it is, and then it impacts the world around us somehow? What's the connection?
I think you can approach this two ways. And the first is to say that we ultimately, if you look at just the broad context of the economic system we live in a capitalist, broadly, society.
Mm-hmm.
And the way that you influence people's behavior in a capitalist society is with economic motivators.
Mm-hmm.
So you can create positive things, you can create negative things. You have additional taxes on gambling and liquor, and you may have tax credits, which we'll get to later, for having children or lower rates for being married. You have these levers that you can pull to influence people to do good and to do things that you want societally and morally through using tax as a lever. Mm-hmm. The second thing is that the government is funded through the taxes that we pay
Sure.
to the various forms and localities and levels of government. And so each of these levers is shaping the governmental system we live in, how they're getting funded, and what programs they're accomplishing.
Roads, education, defense, a
right.
whole variety of things that we do in our government system that our government's responsible for has to be paid for some way.
That's
and
right.
that's fundamentally usually done as a form of taxes.
That's right. And some of them are very general. You know, defense gets paid out of this big bucket that we pay to the U.S. federal government. Mm-hmm. And on the other hand, Social Security and Medicare are funded by two taxes.
Right.
And that's it. It is a specific tax that goes to a specific program. So sometimes you can tie it very directly, sometimes it's more broadly, but every government program ultimately has to get funded by some sort of tax.
That's true. And we have property taxes, sales taxes, income taxes. I mean, even tariffs arguably are a form of tax.
I would argue that.
Yeah. But it's the government saying, if you're going to do this, here's the cost of that. And that goes into funding certain aspects of what we do. All right.
That's right.
So that's taxes. That's how the impact goes. Okay, again, high level. But we also have, you mentioned this earlier, tax deductions and tax credits. Mm-hmm. Can we unpack what those are a little bit, just considering taxes being filed? And if you're doing well, you probably were looking for tax deductions and tax credits because it lowers what you're supposed to pay the government. But what actually are they?
Sure. A tax credit is a dollar-for-dollar reduction in the amount of tax you pay. So let's just throw out some round numbers here. Bear with me on some numbers. Let's say you make $10,000 in a year and all of that's taxable. Your tax rate is 10%. So you owe the government $1,000 in taxes.
For the record, that's not tax advice because those are not real rates or amounts, but yes.
No, if you have any actual tax questions, you should speak to your CPA. And if you don't have one, I'd love to be yours. So let's say you have this $1,000 tax bill that you owe. If you have a tax credit of $1,000, great, you don't owe any tax.
But if you had like a $500 credit, you'd only owe $500 in taxes because the credit goes directly against what you owe.
That's right.
Okay.
Now, on the other hand, let's say you had a tax deduction of $1,000. A tax deduction reduces the amount of your income that gets taxed. So if you had $10,000 of income, you get a deduction of $1,000. Now your taxable income is $9,000. So the government doesn't care about the 10 grand, it just cares about this 9 grand.
And so you go from $1,000 in taxes to $900.
That's right.
Which means the tax deduction is nowhere near as good as a tax credit.
That's correct.
Right.
Exactly.
If you hear politicians and electeds talking about tax deductions, that's weak sauce, relatively speaking, compared to a tax credit. Tax credits are something they are far less likely to do because they tend to be significantly more impactful both on their bottom line. Okay, the difference in the $1,000 credit versus $1,000 deduction, one of them is like no tax paid, and the other one was $100 less tax paid, and that's a huge swing for them.
So you ultimately have to look at the overall impact of these. Of course, this is all just in a vacuum. If everything's the same numbers, and you get to pick one or the other, you're 99.9% of the time going to take a tax credit, right?
If you have to pick one, absolutely.
However, a lot of the levers that we have in tax policy are deduction based.
Right.
When I think about the most recent large tax policy that went through, one of the most impactful things for seniors is this huge standard deduction increase for seniors.
That was the one big beautiful bill. They had that massive. Well, that was before that. I'm sorry.
No, this was the one big beautiful bill.
Yeah, where they raised the standard deduction rate to a much higher number.
So you're actually thinking of the Tax Cuts and Jobs Act. That's the TCJA that was passed in 2017 during Trump's first term in office. That
basically doubled it almost.
Doubled it.
Yeah.
So I had a lot of my clients at the time who went from, who were getting thousands of dollars more back on their taxes. They were paying thousands of dollars less in taxes, not because anything changed with respect to credits, but because they had another extra $15,000 of tax deductions, which to them at their tax rates translated to a whole lot more money back in their pockets at the end of the day.
I know personally I used to itemize, which we can talk about at a certain point.
Sure.
But once the standard deduction functionally doubled, I didn't need to do that anymore. That was a better deal.
That's right.
All right, so now we need to go into tax credits a little further. There's two types of tax credits. There's refundable tax credits and then considered classic tax credits.
Right.
What's the difference there?
So you've got non-refundable tax credits and refundable tax credits. We're going to go back to my example earlier because it's round numbers and I think everybody likes round numbers, okay? So we will look at the child tax credit's a good example. Right now you're sitting at about $2,200 per child on that. Of course, circumstances can be different, but let's just use that as a baseline here. Now, if this credit were non-refundable against your $1,000 tax bill, that means you only get to use $1,000 of that $2,200.
Because it gets to zero, and then it's
That's
done.
right. It just reduces your total tax liability to zero, and you get no more benefit after that.
Right.
No more money back in your pocket. It's kind of a use it or lose it situation.
You just don't pay taxes.
That's right.
And then it taps out.
You can't go negative on your taxes where the government owes you money. But with a refundable tax credit, the government now owes you money. If you go beyond zero, you can actually go into the negative, essentially, on your...
And then the government's paying you.
That's correct. So, looking at it, most of the time, refundable tax credit isn't something that we think of when we think of this broader category of welfare programs, but in reality, it does form...
There's a subsidy component.
Yes, it is a subsidy.
The government is subsidizing a type of behavior, whatever that credit. And because, like for example, a couple of years ago in our state, they had tax credits. I think even some of them were refundable. I'm not positive on, for example, buying electric vehicles or getting solar power on your house, that sort of thing. Some of those were refundable.
That's right.
And depending on how much tax you pay, that could be enough to push it the other direction, where the state is paying you, in a sense, to change behavior. That's the taxes affecting society, right? Like there's an element of that, but it's very much pushing a preferred behavior and a preferred policy point.
That's right. And one of the odder examples of this in recent Virginia history is there is, and I'm blanking on the exact name of this thing, but essentially it's a gun safe tax credit of up to $300 per person per year in the Commonwealth of Virginia. You got to go online and apply for it. But if you buy some piece of gun securing equipment in the Commonwealth of Virginia from a federally licensed firearms dealer, you can get a dollar for dollar tax credit of up to $300 against your Virginia taxes, which blew my mind. How often do you have that? I thought that was a really cool example of some bipartisanship here, where you have people on the right who are going, heck yeah, free gun equipment, and people on the left who are going, well, now the guns are locked up.
Right, yeah. Right. They found a place of mutual interest that achieved its result in a tax bill.
Exactly, and as far as I'm aware, that is still in effect. I should probably check on that.
Probably, but as a concept, there's one of the ways to do it. Okay, so there's two of them. Now, recognizing that we are dealing with a lot of students at Pathfinder, that makes a lot of sense, okay? Obviously, one of the tax credits that comes up most often when we're talking to their parents, because I've been working on this issue now for a couple of years, is what's called the child tax credit.
That's right.
What is the child tax credit?
The child tax credit is pretty self-explanatory. It's a tax credit
for having children. When they're under a certain age, they have to be what's called a dependent, right?
That's correct.
Once they're no longer a dependent, the credit goes away. So parents, when your kids graduate and leave, your tax bill may go up. Also, some of your expenses may have literally walked out of the door. So that might work out okay for you. But that said...
And also when your child turns 17. So this is the unfortunate piece here is then it goes into a related credit, but the amount goes down from a multi-$1,000 credit to a $500 credit. But again, it is a tax credit, dollar for dollar reduction of your taxes for having children. And this has been a policy that's been in place for decades.
But with a lot of different variations.
Oh my goodness, it's probably the most changed credit, aside from maybe research and development, in U.S. tax history.
Because I think it came in the 90s, is my memory of that. And it was a few $100s per kid.
That's right.
But that was weird because it had a couple features to it. First of all, if you are the oldest kid, if you're the firstborn, you're worth more than the rest of your siblings. Okay, so the first kid was apparently the most expensive kid according to the government, and obviously was worth the most as a firstborn. Okay, I appreciate that. But it meant that my younger siblings were apparently not worth as much as I was, because apparently it was cheaper to have 2 or 3 kids than just to have one. You could just somehow mash the cost together, and I'm just looking at our food budget, our clothes budget, and I'm like, I don't know how that works, but that was a thing. And that got changed at a certain point where they said, actually, it's probably bad that the government values different children at different dollar amounts based on birth order. Yeah, bad. Okay, so that got fixed. And then the other thing that happened is the amounts have changed multiple times. It was 500, it was 1,000 something. I think under the Tax Cuts and Jobs Act, they got it up to $2,000. But that was with a timer where it jumped up to that amount, and then it was going to fade back down. I think last year it was going to go back to that original number.
And let me tell you, whenever you start taking $1,000 a child out of people's pockets, a lot of people are going to get really, really upset.
They notice. Notice.
If you want to talk about ways to get voted out of office really fast, that's probably at the top of the list.
I traveled around the country last year, and a bit the year before that, on this particular issue. And I would meet with parents and their kids, and then we would go in to meet with congressmen, senators, their staff around the U.S. And there were people showing up in places that I didn't even know how to pronounce the name of the town, saying, "Oh, no, you don't. This is not going away. You need to make sure that," and it was one of the things where you had the left and the right. There were bills by Democrats and Republicans saying we are going to make this temporary increase in the child tax credit permanent, and both sides agreed on that. That was actually not a point of significant contention. The question was of how much and other things, but the fact that it was going to be made permanent and at that higher number was generally fairly commonly held. However, there was another aspect to that, and that was the fact that that tax credit was not originally tied to inflation.
And that is my favorite feature of the revised child tax credit, is that it is now tied to inflation. Inflation's been on a lot of people's minds. We've undergone some pretty heavy-duty inflation, a lot more than the historical average of about 3%, but we've seen much, much higher single-digit inflation in the past few years.
Let's play macroeconomics for a second.
Okay.
We need definitions. What is inflation?
Yes. Inflation is the rate at which the cost of a basket of goods, or just kind of the cost of everything, is going up. We live in a society where we have a monetary supply that's increasing. The government is allowed to print money. This is Keynesian economics for those of you who've taken that. And so as a result, when you live under this economic policy, price of everything's just steadily going to go up. And this is not a flaw in the system, this is by design. That is the way things are supposed to work. If there isn't inflation, that's bad. If inflation is high, that's bad. You're trying to keep it at a small and constant rate.
Which I think the target is 2 to 3% is kind of the target goal. So when it jumps to 10, 12, 19, whatever it is, people, rightfully so, start to flip out. Because it does horrific things to your price at the grocery store and to your price at the gas pump and other things, because suddenly those prices become very visibly high very fast.
That's right.
All right. However, tax credits, traditionally, it's been fairly uncommon that they've been tied to inflation. So what happens to a tax credit when inflation rises?
The actual value of that credit goes down, because $1,000 today and $1,000 10 years from now do not have the same value.
They don't have the same buying power, right?
That's right. That $1,000 may only buy $800 worth of stuff in 10 years.
Or less, depending.
More likely than not less.
Depending on the year, right.
Exactly.
So one of the things that happened in the most recent bill is that the $2,000 child tax credit went to $2,200, which you mentioned earlier, and it was tied to inflation. That's a particular novelty, because it means that every time inflation goes up, that tax credit will rise with it. So you're not going to be losing value over time with the credit. It should hopefully be most roughly synchronized to not have devaluation as it goes along.
And one of the important things when it comes to tax policy and writing things like this well is to build inflation measures in here. Again, this is designed into how our economic system works. It's not unexpected. It is fully expected. You know the price of things is going to go up. You know that dollars are going to be worth less in the future than they are today, unless something goes horribly sideways.
No.
So when you're putting these bills together, this prevents you from having to update it and have this big political knockdown, drag-out fight over how much to increase this credit. Is it a good idea to increase this credit?
Because
instead, you just set it, you forget it, and if you want to change your policy in the future, you can have that discussion while the current system is working as intended.
Because Congress is so very good at going back and cleaning up old legislation and bills.
Can I ask you, for the, and I think it's the 27th Amendment, the most recent one passed. That passed in the 90s. That's the one talking about Congress's pay. And that if they increase their pay, it doesn't take effect till next Congress.
Correct.
You know, it was in the Bill of Rights, right?
Yes. Yes,
and,
I do.
It took them, 200 years, give or take, to pass that? So Congress traditionally is not phenomenal at this sort of thing.
No, they're not. No, they're not. Now, the child tax credit is the one that got all the news last year, and a couple years before that when it went up. But there's another tax credit that runs with it, that if you've done your taxes and you have dependents, you probably, like at least the software I use, so do you have any kids? Yes, here's the kids. You click the boxes and it drops it off and says, all right, do you want to claim the child and dependent care tax credit? I'm like, well, that sounds good. Can I have that one too? Click. And then they go through a series of questions I always do it. I know the answer is going to be this. And the software is like, you do not get the credit, no. And it bounces it back, okay? It feels very harsh. Because it always asks you, would you like the credit? And the answer is yes, and the answer is no. But can you explain what that is?
Absolutely.
Okay.
Little bit of history on this one. The Child and Dependent Care Tax Credit, we're just going to call this Dependent Care Credit, okay?
Sure.
It's a lot faster. I don't want to spell out this acronym every time. But the Dependent Care Credit has existed in some shape or form since the 1970s. And wouldn't you know, a lot of the provisions haven't been indexed to inflation.
That seems to be kind of par for the course. The fact that the child tax credit now is something of a novelty right now.
That's for sure.
Yeah, right.
The idea in the 70s was to incentivize, going back earlier in our conversation, talking about incentives for people, social incentives, moral incentives. This was to incentivize both parents in a household to work. Dad's working outside the house,
right.
Mom's working outside the house. Well, if both of them are working outside the house for pay,
right.
You suddenly have a situation where somebody needs to be at home watching the children, or
right.
they need to be
cared for somewhere. Right.
That's right.
And this is designed to do that.
Exactly. And so in a situation where both parents are working, this provides some degree of a tax credit, usually around 20%, for the cost of providing care to children.
Right. Because, wouldn't you know it, the cost of childcare is sometimes more than the second spouse working is making.
It's horrible.
Childcare can be very, very expensive. So that was kind of the initial part of it, and it was designed to be used in a two-parent family where both parents are working. And then they modified it slightly to add another part of it, which was if you were in a single-parent family.
That's right.
That also worked, right? Because there's no one to stay home with the kids, which I can see the logic of that, right? Like you can be like, all right, I both need employment, I need to work and be able to make money to be able to take care of my family, but I also need someone to take care of my kids, right? Like those need to coexist. But once it kind of evolved its way forward through the legislative process, what we got to was a place where if you live in a traditional family, mom and dad, one parent working, one staying home and taking care of the kids, you don't qualify for credit.
That's right. You don't have that. Or let's say mom has to work outside the house. Dad's in a situation where he broke his back on a job site accident, and he's not able to go outside the house and work for pay. You're straight out of luck. Mm-hmm. Even though you're in a situation where you have a two-parent household and only one spouse is physically able to work, you don't qualify for this credit because it does not count. You have to have both spouses working in order to qualify.
Or only one.
Also,
one parent.
That's right.
Yeah.
The maximum amount per dependent that qualifies for this is $6,000 of childcare expenses. So that's $500 a month, about $125 a week.
If you're getting childcare at that rate,
please drop that in the comments.
There's some people who would be very interested to know, because no one's getting that, right?
If you can find that from somebody who is reputable
and legal,
yes,
like actually paying taxes and filing their forms, as opposed to Susie from around the 13-year-old from around the corner who's watching you. Okay, that's one thing, but that's not what this is. This is like professional childcare. Okay?
Yes, and oftentimes you will see summer camps and things of that nature that get folded into this.
Yep.
Any examples of that that we might be able to provide?
There's a few. We have one. There's a summer camp that we do. It's called I Govern. We'd love to have you come. That being said, those programs actually are included because they're things that allow, that fully take care of kids. In fact, there's a remarkable number of kids and families that take advantage of childcare. But when you think that, you don't normally think childcare in the form of. You think of it in terms of someone watching the kids when the parents are out, but there's actually a whole bunch of examples. We've been doing some research recently of traditional families where, for one reason or the other, childcare is a necessary component of their budget, but they don't get the same relief everyone else does. At least the both parents working or the single parent family. And what we found is we've gotten to a place where the disadvantaged aspect of this is what we consider a traditional family, what we consider a best model, where there's both parents, one's engaged with the kids. That one is actually disadvantaged in our current tax system, where the government said, we are preferring you to be in financially, we're preferring you to be in one of these settings than in kind of your traditional best practice family approach.
That's right. And let's even go further in. Let's say you have a situation where you have a family business. You have dad, you have mom, and they're both engaged in this family business.
Sure.
Oftentimes you see this where it's a family construction business. Dad is going out to the job site. He's serving as the project foreman. He's serving as a general contractor. He's doing this. Mom is doing some of the scheduling, and she's doing some of the design, the administration, and doing this. I would know. I've dealt with a lot of construction companies that work on this exact model. But for legal purposes, because dad is the general contractor, he owns 100% of the company.
So she's not listed as...
She's not listed on there, even though the money's going straight into their joint bank account that they both are deciding how to spend the money, both spending the money together. They're both working on this together, but legally, dad is the only owner of the company for regulatory or legal reasons. Well, in this case, if you look at the tax return...
They're not getting that.
That's right.
The other one that came up recently in some of our research, you see this also apply when you have families where there is some sort of mandatory obligation that one parent needs to engage with the kids. So you see this particularly in families that are going through the adoption process or foster care, where there's an element where kids have to be at court dates and they have to have their foster parent or guardian with them. But that's not always something that the rest of the family can come to. So suddenly you have one parent working, one that has to be out with this child, and the rest of the kids. And they're in a healthy, stable place with good parents that are fully engaged. One's working really hard, as a job. The other one is engaged, is caring for people that are disadvantaged and hurt in society that need that care. And they're kind of getting screwed by the tax policy on the same time for doing stuff that's good and right and just. The effort we're talking about here is the fact that this might be a place where the tax code has, I'm not going to assign malicious intent to the design. We've gotten to a place where it's actually... The government's got its finger on the scale against what is best for families and kids. And that's not how we should want taxes to be.
Right. And I just want to be clear, this is likely not intentional.
No.
It's very, very hard to catch every edge case. As anybody who has written a bill in an iGovern camp can tell you, it's really, really hard to catch every edge case. You're going to have somebody say, well, what about this?
And there's an effort right now in Congress, actually, to address this. It's actually they're looking at either putting it in the reconciliation package or a separate bill. There's some debate as to the methodology. But to say, you know what? There are legitimate cases where, two-parent families, one parent working, one taking care of the kids, stay-at-home, homemaker, whatever the category you want to call that, where they have childcare expenses. Caring for your kids, even in a two-parent stable family, is not free.
That's right.
Kids are expensive, and that's not just the existence of the kids, like the child tax credit. It's also the care for them on occasion, where you need that too, and that applies to summer camps. That applies to babysitting, regular, etc. It can apply. In fact, the credit can apply to basically anyone with this. There's a lot of different ways that can be, including someone that's family member, etc., that is paid regularly as part of this. That's applicable if you have an extended family member, cousin, aunt, grandparents, etc.
You just have to
report it. You have to do it the right way, right? Absolutely.
Run it around to Caesar what Caesar.
Actually do it justly and legally, but that's not an illegitimate expense that can be reported that way, and that's a good thing. Now, that said, we just went into the weeds. Let's be honest. We seriously nerded out on a particular piece of the U.S. tax code. Why? At a macro level, why do we care? Why does that matter?
Because, as we said earlier, bring this full circle, the tax policy decisions that we make as a nation impact what we're incentivized to do as people. It incentivizes what people can afford. It incentivizes what people will do with their money when you're struggling to try to make ends meet. And you're able to get a tax credit that helps you get the childcare you need to continue with this adoption process, continue with this foster process, continue the family business. That's real and tangible to a lot of people, to continue a traditional two-parent family structure where you have one working parent outside the house and one who can devote their full time effort to their children. Mm-hmm. This is crucial. It's more expensive to live now than it has been in most prior times in the United States. And so this is going to be important to the mental and social health and well-being of us as a society and of our children. So this is important to make sure that we can actually do all of these things.
I think sometimes we forget that economic policy and tax policy has a moral component. It affects families and people in tangible ways. And I think sometimes it's like, well, that's dollars and taxes, and that's not a moral question. That's not an ethical aspect. That's not a family social values question. But economic policy can have a huge impact on social values, on family, on people, on individuals, and frankly on the well-being of kids and families and their ability to care for them, particularly when you see just prices going up. You kind of wandered into it, but I think it's an important piece to know. And I guess I should say here now, this is an issue particularly that Project Pathfinder is weighing in on. So if you are interested and engaged in something like this, and admittedly, you might be kind of outing yourself as a nerd. That's okay. You'll be in good company, okay? But
guilty as charged, Your Honor.
True. One to another. But that being said, we'd love to have your help. So if you're interested in helping us see if we can make this better for families holistically, and for the record, this isn't taking away from anyone who already gets this. This is just saying that it is being applied evenly and equitably and fairly to all families when they need to take care of their kids. That care costs would be done no matter what structure they are currently in. Sometimes those choices are things people choose, and sometimes they're not things people choose. They are choices forced upon them. For one way or the other, what we don't think is that should dictate the government saying yes, good, bad, no, in that aspect here, particularly when it comes to caring for kids. We want them cared for well. We want families to be able to care for their kids well and be able to afford it. Particularly with that idea of adoption and foster care, when people are actually reaching out beyond their immediate family and going, hey, we're adding people to it who need this. We're helping take care of kids in horrible places or situations right now. We don't want to make that harder than it already is, and it's already hard enough. If you're interested in working on something like that, we are working across the U.S. in about 7 or 8 different states right now to work on this issue. So feel free to shoot us an email at info@projectpathfinder.net if you're interested in helping. Get us your name, some contact information, and the state you're in, because that's going to matter for the project. We're currently working on a Senate aspect of this, so we'd love to have your insight on that. As far as where you are and what's going on, we'd be happy to give you some more information on that. I should say thank you for being part of this. I know we're running out of time.
Thank you for having me on the podcast. It's been my pleasure.
That being said, again, if you're interested in helping us see if we can reform the process, we'd love to have you help. Just leave a comment, shoot us an email, that'd be great. But that being said, Elissa, thank you so much for being our host today. I'm sorry, we kind of nerded out rapidly, but you've seen us do this before, so This couldn't have been entirely a surprise to you.
Well, hopefully our viewers have enjoyed this, and people who are listening have enjoyed this kind of discussion. I've certainly enjoyed listening and have learned a good bit myself. Thank you again, Parker, for coming in and joining us. As some of you guys have probably been watching this for a little bit, if you've seen other episodes, this is a little bit of a different format we're trying out this time. Parker happened to be in person with us, so we didn't need to be zooming in across the country, but we're trying new formats. So if you like the format, let us know in the comments. That would be great. And if this is your first time listening to us or hearing about Project Pathfinder, you can go to projectpathfinder.net to learn more about our organization and the work that we do, civics education for high schoolers and beyond. You can also find us on Instagram, LinkedIn, Facebook, all the socials, and of course at Project Pathfinder HQ here on YouTube. Subscribe to the Pathfinder Report on any place that you can listen to, and we hope that you guys will catch future episodes with us. Have a great day.